This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 16th. Some highlights from today's show. China and the US both really want to talk to each other. US equities are nervous ahead of Powell, and gold signaling a blow off top. Good day traders, and welcome to another daily market rundown. Let's take a quick look across the European board. It's very much a tale of two stories, of course. We had a little bit of negative overnight sentiment. We can see that Asia was down quite a bit, of course, on the Nvidia news, and we'll get to that in a moment. But then, of course, we had some more headline news coming in over the wires early in the European session about the US and both China wanting to talk. It's just no one wants to make the first move. And the reality is, I think what we can see across the screen is that from a bond perspective, most of the risk off move is now being priced out. We can still see a little bit of nervousness around the equities, but it's very much retraced most of that overnight move. And of course, if we go and have a look at the currency space, we can of course also see the likes of the Swiss franc and yen giving back quite a bit of that risk off flow. So the key takeaway from it is that yes, we had two bits of headline news, and we'll discuss those in a moment, but both of them net to net have sort of not given us any new information. They've just created a little bit of volatility as we move, of course, into the US session. Now, with that in mind, let's get across and talk about some of that overnight news, because I think it does matter. And the first one, of course, is very much about Nvidia. As I said, there was news overnight about Nvidia. I'll get to that in a minute. There it is there. So news came out overnight about the US government wanting to sort of ban and restrict the sales of certain Nvidia chips to the Chinese. Now, again, the market moved a great deal on this, not because it's big news. Okay, yes, Nvidia is coming in down 6% on the open, but I do suspect most of that is going to be retraced over the US session. The reality of the situation is that this isn't new news necessarily. The Biden administration was looking to do this exact same thing. They had the policy in place and they were going to trigger it. Unfortunately, it was not triggered, and Trump is just ultimately doing what the Biden administration had been wanting to do. Okay, there is of course this ongoing tug of war in the AI space about not giving China the necessary chips to give them that AI lead, and so yeah, is now the first time we've actually seen that restriction come in place. Now, I suspect the reason Nvidia is down so much is less to do with the actual news and more to do with what Nvidia is saying, which is this is going to, of course, cost them around $5.5 billion. Okay. Now, again, does this matter in terms of the big picture? Well, I think where it does matter is from a sentiment perspective. Keep in mind, no one really wants to be aggressively sort of buying up risk at this point in time. There just seems to be a lot of potential headline risk. And so I suspect what we're seeing is just perhaps, of course, Nvidia did bounce quite aggressively over the last couple of sessions. So perhaps we're just giving back a little bit of that move that we have seen, of course, over the last 6 or 7 sessions. And there it is. You can see Nvidia bounced all the way from $88 all the way to 114. You know, quite a significant rally over the last 6 sessions. And so I suspect this gap down is less to do with the news and a lot more to do with the positioning of the market. Okay, it's kind of a case of, investors, of course, they saw that very aggressive sell-off starting in March. And I just want to annotate that because if we think back to sort of, Wednesday, Liberation Day, I mean, we're effectively trading above Liberation Day prices in terms of Nvidia. Okay, so hence just showcases the point that I think Nvidia is down not on the news, but more on the case of we have very aggressively rallied. We were above those Liberation Day levels, and so a little bit of forced profit taking is perhaps what's creating that move in Nvidia. Okay, now what that means ultimately is I suspect once we open, we will start to perhaps see a little bit more buy-side interest come into the market and trade that gap closed. I do think that's probably one of the high probability plays. Could we go lower? Of course we could. Okay, we could first snap a little bit lower. I think anywhere around that $100 to $102 a share is going to find some sort of buy-side interest. So keep a close eye on that. Okay, I think Nvidia will be a very good proxy today. If it opens and starts to gun straight away for that gap fill, I do suspect the indices are going to fill that gap very quickly and also even perhaps showcase a very decent short squeeze on the day. Okay. Now with that in mind, I think the other news was of course all about the Chinese willingness to talk. This isn't new news. Okay, this has been ongoing for a while now. The the US says they want to talk. Trump has told us he likes Xi Jinping and he's waiting for the phone call. The Chinese have said they want to talk, but they want some more respect. And so both sides want to talk. It's just neither side wants to seem like they're, of course, making the first move, because that is, of course, showcasing some form of weakness. Now, again, this isn't necessarily new. I suspect the markets moved in the way they did simply because of where we were trading on the day. Okay, the point is, net and net, we're flat after both those headlines. Neither headline matters really much. What I did say yesterday and the day before that and the day before that is I suspect we have turned a corner on the worst case scenario. I think this is as bad as things get from a tariff perspective. And so the focus now for investors is going to turn to the actual real economy, and to get sort of equities, in a sustained uptrend, or of course to continue the downtrend, we are going to need to understand exactly what the impact is on the US economy. And that's not going to become clear anytime soon, because we are going to need to wait for those tariffs and that uncertainty to actually filter in to the eco data. Now, with that in mind, of course, Powell is up today. He will be closely watched. I'm not so sure why, but of course, we do need to pay attention. He is the governor of the Federal Reserve. And I think the key takeaway, and we'll go through his previous speech, which was just over a week ago, the key sort of takeaway is, does he sort of follow that same sort of approach that he spoke about 2 weeks ago, which is a lot of uncertainty, but we're not about to make any decisions anytime soon because we need to understand it better, or does he shift? Okay, again, like I said, the odds of him shifting when just a week and a half ago he was very, very clear is very, very low. Okay, so I don't think we're going to get anything significant, but we will, of course, watch it, no doubt. Now, the key thing is, in terms of the Fed, what we have seen, of course, was Fed's Waller came out just a couple of days ago and said, look, if things do deteriorate quite quickly, we can cut a lot sooner than expected, a lot deeper than expected. And he was very much in that camp of, being quite dovish. But this idea of a sacrifice ratio, I think this is what Powell's been talking about. He spoke about this during the last FOMC. And it's this idea that, look, we may not need to ultimately worry too much, because should we see a little bit of demand destruction, should we see unemployment rate tick up, that ultimately will have a net negative effect on inflation. Okay, so I think the Fed and Powell in general just want to understand the sacrifice ratio very closely. They are expecting higher unemployment. They are expecting a slowdown in growth. They are expecting near-term pickup in inflation, but they expect that higher inflation to ultimately come back down as a result of some of the demand destruction. Okay, so there's a lot to be seen. I think that's the key takeaway. No one's really sure ultimately what the next step are, but what is of a great deal of certainty for us as traders is we've got to be watching the eco data. Okay, for the first time, since the hiking cycle 2.5 years ago, the eco data does become very, very important, and I suspect the markets are going to become very, very sensitive to it as well. It is a very simple case of good data is good for the markets, bad data is bad for the markets. And when I say markets, I don't just mean the equities, I mean equities and even perhaps the bonds. Okay. Of course, on that note, what we have seen over the last couple of sessions is US Treasuries have seemed to find a nice footing. Not only do we see that in the outright bonds, but we also see it against the German bunds. We can see that spread has narrowed quite significantly over the last 2-3 sessions. Okay, now why does that matter? Because it just generally points to an environment where it's not that all the concerns are gone, it's not that all the fears are gone, but it's a more constructive environment to be, of course, buying dips in the S&P 500, NASDAQ, Russell, etc., etc. Okay. Now, with that in mind, to get some sort of a sustained rally, we spoke a bit about this yesterday, but to get a sustained rally, you're going to need to get a great deal of certainty around these tariffs and, of course, the negotiations that are ongoing. We did see Europe come out yesterday and say, look, we're not really seeing any follow through. We don't really know what the US's stance is, so we can't really come to a table and have any sort of agreement if we don't actually know what the US wants. Okay, but the key takeaway is they've got another 80 odd days before that deadline is reached. So the point is, the next 90 days are going to be a lot of backwards and forths. I expect that we will be inside the current month's range by the time those 90 days are up. Okay, in other words, if you go look at a monthly candle, it wouldn't shock me if effectively this is the monthly candle. If for the next 90 days we just sit inside that entire 500-600 point range. Okay, so keep a close eye on that. I think from a technical analysis perspective, that can be quite handy. Now, one of the things Powell has been referencing, and this is something they're very closely watching, is break-even inflation. Okay, and I think there's a couple of pundits out there talking about higher inflation. They might need to hike, blah 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 blah. The reality is, if we look at where break-evens are, they're sitting around 223, which is the lowest level it's been in a good, 2.5 years. Okay, so sure, 1 year inflation expectations are elevated. Consumers are nervous, they are panicked, they are front-loading, they are expecting higher inflation. But when we look at sort of a bit further out and we look at the metrics that the Fed is making decisions off of, break-even inflation is not only low, but it's also coming down. Okay, and again, for perspective of understanding what will make the Fed turn more dovish and bring and front load those rate cuts, well, we can see if we go to last year, we can see that heading into that very, very bad August non-farm prints, we can see how those break-evens dropped all the way from 2.5 down to that 2.3. Of course, that is the point when the Fed cut 50 and inflation break-evens rallied quite aggressively as a result of that. Okay, again, similar setup here. We can see with all this uncertainty, we can see break-evens have dropped from 250 down to 225. They are at the lowest point they've been in 2 years. Not exactly a time the Fed is going to shift and turn hawkish. Okay, if anything, you've got to be just ready and switched on for the moment we get that dovish pivot, because what that will mean ultimately is rate cuts are coming thick and fast, and not only that, but it could also be a case of getting 50 basis points cuts like we did see last year. Okay. Why this matters? Well, what it ultimately comes down to is, and this is the expression I like to think of it as, we're one very bad non-farm payrolls away from getting a 50 basis point cut. Okay, and that's how the market will trade it. They'll lean on their Powell playbook from last year. Powell does not want to see a labor market weakening too aggressively. He will act, and he'll act decisively and aggressively because he's told us policy's restrictive. They've got a lot of room to move. They think policy's in a good place, but they will safeguard the labor market. Keep in mind, it's far easier for a Fed to protect and safeguard an economy with slightly above inflation, above 2% target, than it is to try and bring an economy back from a recession. Okay, they know this. They are not unaware of this. This is why typically the Fed always leans somewhat dovish. They would far rather be cutting rates to safeguard a recession and then than actually doing the opposite, which is being over restrictive for too long. Okay, so just keep an eye on it. I think data is of course going to matter quite a lot. Now, with regards to Powell, this is what he said a good week and a half ago. You can take a snapshot of that, read it yourself. But the key takeaway is outlook highly uncertain. That's been mentioned a number of times. Ultimately, he said that, of course, most measures of inflation expectations are well anchored, and that, of course, the tariffs will be having a much bigger impact. He did say tariffs are likely to raise inflation, and ultimately there could be some more persistent effects. Okay, they're not quite sure of that yet, and that's perhaps why they do not want to turn dovish yet. But once they remove this idea that inflation is going to be having these persistent effects, ultimately they will then turn dovish and begin the process of cutting rates as soon as possible. Okay, I think the key thing here is Fed well positioned to wait for greater clarity before considering policy adjustments. Okay, well positioned for greater clarity. This was a week and a half ago. I'm not sure anything has changed over the course of the last week and a half. Okay. And then, of course, closely watching tension between hard and soft data. And right now, what the Fed is telling us, what Powell is telling us, is that we can afford to wait. Okay, we don't have to do anything right now. We can really allow some time to start to understand the nature of the beast. Okay, so watch Powell. Fine, there might be absolutely nothing to do, but should he do anything, it's more likely that he's going to turn a little bit more dovish, more likely going to open that door to a cut as soon as the May meeting. Okay, now moving across to gold, I think all the potential for a blow off top today. Why do I say that? Well, look, gold is up 10% since the low point made around the 9th of this month. We have rallied 10% in a straight line. That does not constitute a blow off top. A blow off top is typically where the market positions itself in a trend-like manner after an aggressive move. In other words, we are in overbought territory at this point. Okay, the market then stages a very aggressive trend move from an overbought territory stance. That typically is the first sort of tick checkbox that you want to see for a blow off top. Okay, the next part of a blow off top is ultimately where we get a very high volume move on trend on typically some form of data, okay, or data or sort of commentary or headline news. And that's what we got this morning. We got this sort of risk-off type scenario. We saw it in the bonds, we saw it in the equities. That, of course, like I said, is not necessarily new news. Okay, the news about Nvidia is not a tariff escalation. It's not a China escalation. It's something that was in the news already in the Biden administration. Okay, so we've got that positioning. That's the key. We've got these sort of almost these very aggressive longs, these very sort of intentional longs that have come into the market on perhaps some headline news. They're locked in at the high, and ultimately what we get is an equal and opposite type pattern. Okay, we can see that 1 hour chart is starting to show that equal and opposite pattern. I do suspect over the retail sales we'll start to see that offer, and like I said, once that pattern starts to play out, you don't want to be sitting there buying it. Like I said yesterday, I think the target for gold is for a flush out initially to those 93s and then a retest of 3160s. From a risk reward perspective, we're talking about $150 a downside. From a stop perspective, we should not be trading, of course, above today's highs. So all trades are on offer in gold today. I think there's going to be a really good trade there. With that in mind, of course, don't forget we are now moving into the Easter weekend. It will be a long weekend for most people all around the world, and it starts pretty much tomorrow. Of course, we do have the ECB tomorrow out. We've got the BOC today. They will be closely watched for clues and cues. But the reality is, I think once we get beyond today's key economic data, which is the retail sales and, of course, Powell, I suspect we're going to start to see ranges contract a lot like they did yesterday. And like I said, I don't expect anything to happen in the next 24 to 48 hours. Fine, there might be some headline news about, China likes the idea of talking to the US, and Trump says he likes the idea that China likes the idea. Then there'll be this backwards and forth. But the point is that, like I said, we have turned a point in terms of this escalation. We are now de-escalating. We're just doing it in a very sort of irregular manner. All right, with that in mind, of course, if there are any other questions, do post them in the Discord channel. Of course, stay safe out there today, manage that risk, go make some money.